Good afternoon, ladies and gentlemen. Welcome to another ASX Trading Tips video. Haven't done one of these in a while, but as always, please do not consider this as financial advice because I'm not a financial advisor, nor am I recommending you to buy, sell, or do anything at all. Consider this as education and entertainment purposes only. Now, the point of this video is to discuss emotional and psychological responses to trading. The one thing that really popped into my head in the last couple of weeks was two trades, AW1 and 4DS, and for different reasons in terms of the chart, but ultimately the same thing in terms of emotional responses. Now, for me personally, I love buy the dips. And when I say buy the dips, I'm talking about 70 to 90% sell-offs. I love these trades. For me, statistically, they yield really, really good outcomes. Now, I'm not saying in the future that you're guaranteed to make a bag or two or anything like that. What I'm saying is historically, in my last 8 years, whenever I trade a buy the dip that's selling off 80 to 90%, I tend to make about a bag in returns intraday on the sell-off. So what I find happens is it opens and then flash dips and then rallies. You know, if something opens at around 2 cents, it dips to 1.7 and then rallies to something like 3.5 or something crazy. So 4DS is an example of a stock that went from 9.1 cents to 2.5 cents, and that's about a 70% sell-off. Now, 70% is a bit of an unusual number because from 70%, it can sell off to about 80% and then do the rally. So it's a little bit funny at this point in time, but the purpose of this video isn't to suggest that every buy the dip is a good situation or scenario. The purpose of this video is that I've got a setup that is my bread and butter. It's a micro cap sell-off. It's not perfect, but it's, 70% is close enough. I took the match at 2.5 and I didn't add on through to 2.1. There was a big wall at this point in time. It might have been 2.2. But the point is there was some levels in the order book that I should have taken because, of course, there are people that have stop losses in place. So there's going to be a flash dip on the open. So there's your open at 2.5, then it flash dips down to 2.2. And for me, I should have, based on my trading, based on my skill set and the fact that this is my bread and butter, should have put orders in to take the dip. And of course, it comes back down. I closed at about 2.6 because, of course, it's not rallying the way I like to. Market conditions were a bit funny in mid-August. And I was like, okay, well, this isn't going anywhere. Stopped out at 2.6. And then it rallied all the way to 3.6. So I missed out on a very significant move to the upside. Despite the fact that my trading history of micro caps that sell off large percentage points, whether it's 70, 80, or 90%, tend to yield really, really good results. In this case, I let my emotions get to me. It was just, I wasn't trading the trade. I wasn't trading the setup. I wasn't trading my bread and butter. I was trading the fact that I was concerned about market conditions. I was trading the fact that I was concerned about the order book. I was trading about other things that are irrelevant for me for this setup. And I know what you're thinking. You're thinking, oh, well, surely the order book is important. Yeah, you know what? To some extent it is. But on a stock that sells off 70 to 90%, the order book is less relevant than one might think. For me, it's a massive dip buy, particularly in the first minute or so. Now, the point of this video isn't to suggest that every dip buy is just an instant bagger and everyone's happy in unicorn lands, rainbows and all, because everyone's making money on dip buys. That's not the point of this video at all. It's the point is that the emotional response to this has never changed in the last 8 years. And what I'm saying here is that it's always felt the same. So whenever I dip buy something that's selling off 80, 90%, that anxiety, that pit in my stomach, that clenching feeling in my stomach never goes away. And I guess, I overcome it in my own way, and that really is just dipping my toe in the water, going, hey, I've seen this set up 2 or 3 times and it's worked really well in the past. Maybe I should just try it out. And then, I'm trying it out while feeling basically sick to the stomach while I do the trade. But then I find out it works out. And I'm like, okay. So there's a bit of a difference between how I feel and how I execute. They're two completely different things. But in the last 8 years, buying dips or buying, significant price action moves like this, the emotional response and the psychological response has never changed. That sensation, that gut feeling has never changed. I still feel pretty sick to the fucking stomach whenever I take this trade. Whenever something sells off big time, I don't feel any better. I've got a rational mind that says this is a good setup and this is what I need to do in this particular scenario, and this is where I need my stop losses to manage my risk, and this is where I need to buy, and this is how I need to execute. Right there's the plan, but then there's also the emotional reaction that tries to stop me from executing it. Now, that emotional response can actually be quite visceral, can be quite intense. And I guess the point of this video is that, not everyone's going to be like me, but for myself, and I imagine a lot of you might relate, but for myself, that emotional response has never fucking changed. Not once. So if there's going to be another 90% sell-off that happens tomorrow, I'm still going to feel sick to the stomach. I'm still going to get that extreme sort of anxiety feeling about buying the dip and buying levels below, just below the open, in order to watch it rally to the upside, hopefully. That emotional response never changes. The one thing that has changed is my ability to recognize that emotional response and that I need to just fucking ignore it because it's never going away. I need to recognize that the trade has a plan. There's a certain structure to what I do because I know that my setup in this one particular instance, in this one particular setup, is highly profitable for me with, of course, certain levels of risk management. Now, another sort of reaction that I had was on AW1. AW1 came out with a fantastic copper-based announcement. As you can see here, it opened at about 18.5, rallied to the upside to about 27. Now, of course, you can see there's a horizontal here, so a nice sort of key level to work with. But intraday was a bit of a mess. Now, this time of the month, it was actually really bad. Like, we're talking early September, just after August, where August was really rough in terms of liquidity. So we see this price action, right? I get the match because the copper announcement in my head is a 50 million market cap target, which is about 28 cents, which is, as I mentioned before, the daily horizontal. So I have a plan in my head. I've got 18.5, which is the match. Take it to about 28 cents. That's my plan for the day. Now what happens is it pops to 20.5, and I'll bring up VWAP as well. So it hits 21, comes back to 19.5, and I have an order here to buy the dip, right, to hit VWAP, because I figured what happens typically is when there's a news announcement, particularly a strong catalyst news announcement, when a stock rallies, it tends to come back to VWAP and then continue to the upside. That's very standard trading. That's textbook trading 101 for me. But what happens is not only do I get filled at 19.5, and mind you, I also got 20.5 on the way up as well. So I'm sitting at orders at 18.5, 20.5, and 19.5. It starts to drop. So I'm in negative because the bulk of my position here is at 18.5. And then of course I'm adding on at higher prices, and now I'm sitting at negative as it comes back down to the double bottom. There's a mad gut-wrenching feeling that this is going to break range, because of course what happens on break range, if it goes below this 18.5, it's likely going to puke, right? That's just stock standard range break stuff. But in my head, I've got an order here at 18.5 for this double bottom. And it is really gut-wrenching because I'm putting on size. Because in my head, the fundamentals are 50 mil market cap. That is my target. That is my target based on these copper drill results. There is no situation in my mind that this sells off and gap fills to 13.5 or comes back down to whatever level. So it's a gut-wrenching feeling when this comes down for a double bottom. Now, double bottoms aren't inherently bad, but double bottoms don't typically happen on really good fundamental results. So I'm adding on to the trade at 18.5. At the first touch of 18.5. It bounces, I feel good, but then guess what? It rejects off VWAP and comes back down to make a new low at 18. So for me, I've got two minds about this. The emotional response of, holy shit, this isn't working for some reason. I should probably get out and save the money that I have, save my capital. But the other part of me is going, hold on, the fundamentals of this stock are fucking phenomenal. Even though the liquidity is kind of tapering off because the August period, for whatever reason, has been pretty illiquid. But the fundamentals are so strong that we're basically looking at a move from 18 cents to 28 cents, roughly, from a fundamental perspective, based on what I know about drill results and peer comparisons. So to see it not only double bottom, but to fucking triple bottom is a gut-wrenching feeling, because how often does this actually end up going green? Very, very rarely. This is a very rare thing to happen. But fundamentally, again, I've got to ignore the little bitch voice in my head that's saying get the fuck out at 18 or 17.5 and save your capital, because the fundamentals are so good. And of course, it ends up eventually pushing to the upside. And this is what I consider the easy money, is once it breaks this horizontal at 21.5, from here, cool, we've got a base, and now it just does whatever the fuck it needs to do, and then push on to the upside a little bit further throughout the day. So as you can see, if I turn off VWAP, make it a little bit cleaner. Yeah, as you can see, it just ends up pushing all the way to 27, which is really nice. So this entire play here, the emotional response to that was quite visceral, right? It's just like this response of disgust, because I've got in my mind an understanding of what this company is valued at, but the market for 45 minutes is not agreeing with me, right? It is here and here and here. It's agreeing with me, right? It's holding the bottoms. But to triple bottom on a strong fundamental news announcement for 45 minutes is a pretty gut-wrenching feeling, right? Because stocks like this in high liquidity markets tend to just pop, right? Maybe, like I said before, hits a high, comes back to VWAP, and then creates a base, and it does it a lot sooner. It probably in a real sort of normal market does this real early on, hits the previous high, and then keeps going. But instead, it fucks around VWAP, retests the lows, then retests VWAP, and then triple fucking bottoms of all thing, and then it does the thing that's considered normal. So, the emotional response to that is pretty gut-wrenching, but it's all about acknowledging, for me at least, it's all about acknowledging that emotional reaction and just ignoring it and putting it to the side. And look, it's easier said than done, but some setups simply have worse emotional responses or stronger emotional responses to the setups. And for me, it's about identifying the emotional response and just dealing with it, just ignoring it, right? Because some setups are so fucking good that the emotional response for me needs to be managed. It needs to be ignored. I need to identify what it feels like, remember what it feels like, so next time I can ignore it. Or next time I at least acknowledge that it's going to be there, but then that I need to ignore it. Now, just because I'm ignoring the emotional response doesn't mean I'm ignoring the risk management. Just because this hit 18, I was willing to probably give it to 17.5 and 17 because I still got to manage the risk. If this stock tanks and then comes back up with high volumes, then it's all about re-entering. And again, there's the emotional response again. It's all about managing the fact that, the risk is managed, and then on the way up, I can't ignore high volumes because, again, fundamentally, this stock was so strong that I'd have to find reasons to get back in. Instead of dwelling about the losses here, I'd have to find reasons to get back in the stock in order to make the broader move to the upside. So emotional control is extremely fucking difficult on some setups. So it doesn't get easier. For me, it doesn't get easier. For you, if you're a psychopath, if you're cold-blooded, then you might really do perfectly on the markets. Otherwise, for us average mortals, keep in mind the emotional response for you may actually not change for the setups. So keep that in mind.